So what I'm doing here for chapter 8 is I'm going to assume that you've read over the material. And again, um, it's within the confines of tax accounting. It's not so much conceptual in nature. It's more, can you apply said rule with said problem? So what we're going to do for this chapter is, like I said, I'm going to assume you've read through the material. Um, I've picked out some problems that I think are representative of each, at least important section within the reading. So hopefully, as I walk you through doing those problems, you'll see how they interrelate um, the various nuances of working with these specific portions of tax law. So first problem is 839. During the current year, Karen sells her entire interest in Central Corporation common stock for $22,000. She is the sole shareholder and originally organized the corporation several years ago by contributing $89,000 in exchange for her stock, which qualifies as Section 1244 stock. If you remember, 1244 stock has special allowances for um, deductions related to loss in value there. So that's why that's set out there. So, as soon as you see that, you should be looking up the relevant section in your book that deals with 1244 stock, so that you can see how that's going to affect this question. Continuing on, since its incorporation, Central has been involved in the manufacture of items that protect personal computers from static electricity. We don't really need to know that. Unfortunately, this market is extremely competitive, and Central Corporation incurs substantial losses throughout its existence. So for part A, assuming Karen is single, what are the amount and character of loss recognized on the sale of Central Corporation stock? Okay, so we see from the facts that she sells what she has in the common stock for $22,000, so that's what she got. Her basis is what she contributed in exchange for that stock of $89,000. So you see a recognized loss of $67,000. So then we have to go in and see, okay, since this is a special situation of 1244 stock, how does that affect the characterization of this loss? And we see, if we look up section 1244, either within the book or in the code, that the first $50,000 of this loss is ordinary loss, with the remainder being long-term capital loss. And remember, that's important because ordinary loss can offset ordinary income, whereas capital loss, for the most part, is only going to be able to be used to offset capital income. For part B, assuming Karen is married and files a joint return, what are the amount and the character of the loss recognized on the sale of the Central Corporation stock? Well, nothing really changes here except that as a married filing jointly person, now all of a sudden the 1244 limit is doubled to 100,000, and so the entire amount can be characterized as an ordinary loss. And part C, how would your answer to part A change if Karen had originally purchased the stock from another shareholder rather than organizing the corporation herself? So basically, the reason that this would change is because if Karen had purchased it from another shareholder, she wouldn't be purchasing it directly. And if you look at 1244, the provisions in 1244 allowing for the certain, either the 50 or the 100,000 to be used as an ordinary loss do not apply if it's not stock issued directly from the entity to either an individual or a partnership where the individual who's trying to claim the ordinary loss characterization is a partner. So it would all be long-term capital loss in that situation, because you would basically just ignore the provisions of 1244, and since this is an item that she's had for longer than a year, it would be long-term and capital loss because it would be a capital asset. How might Karen have structured the transaction in Part A to receive a greater tax advantage? Well, basically, what did she run into in Part A? There's a yearly threshold on the amount that can be considered an ordinary loss. So if she were to split up the sale into multiple years so that her loss each year didn't exceed the $50,000 limit, she would, in the end, be able um, to include all of that loss as an ordinary loss. It would just be in separate tax years. Okay, problem 843. In the current year, Claire reports incomes and losses from the following activities: activity X, Y, and Z, and reports a salary of $100,000. X, Y, and Z are all passive with respect to Clay. Activity Z has $40,000 in passive losses which are carried over from the prior year, so these are passive losses that were not able to be offset against passive gains during prior years. So in the current year, Clay sells activity Z for a taxable gain of $30,000. Well, what does that mean? So here in this question, what is the amount of loss that Clay may deduct, and what is the amount that must be carried over in the current year? Well, the fact that he is getting rid of all of his activity, his interest in activity Z, should trigger in your mind from the reading, okay, I remember that when you get rid of a passive activity, your interest in a passive activity, then all of the carried over losses from prior years are able to be used in that current year to offset business or investment income that's not passive. Okay, so in this case, you would have a $12,000 loss that is deductible from non-passive business or investment income. And the way that you get to that number is basically if you take a look at the fact that Z or Clay sells activity Z for a taxable gain of $30,000, well, that offsets right there activity Y and activity Z for the year. So you had losses of $10,000 and $20,000 in Y and Z. You had a taxable gain of $30,000. Those two are offset, so that nets out to zero. So what you're left with there is $40,000 passive losses, which we're able to count against non-passive business or investment income this year because of the fact that we are getting rid of Z this year. So first, of that $40,000, we have to apply any of that we can to passive activities. So that $28,000 of gain is netted against the $40,000 of passive loss. And when you net those two out, you're left with $12,000 of loss remaining that is allowed to be deducted from non-passive business or investment income. Part B, based solely on the amounts above, compute Clay's AGI for the current year. So this is pretty easy. You're basically just taking his salary of $100,000, and obviously that is not a passive business income. That's an active income, but since that $12,000 is now allowed to be netted against non-passive business activities, you total that out, 100,000 minus 12,000 for a total AGI of 88,000. Okay, problem I-844. During the current year, Irene, a married individual who files a joint return, reports the following items of income and loss. Salary, $130,000. Passive activity X, $10,000. Activity Y, rental real estate, non-trader business of $30,000. Similar nature, activity Z, non-trader business, real estate, $20,000. Irene actively participates in the rental real estate activities and owns 100% of both. What is Irene's AGI for the year? And then B, what is the amount of suspended losses, if any, that may be carried over with respect to each activity? So we start obviously with her salary income of $130,000. We subtract out the maximum rental real estate loss, assuming that it's rental real estate in which she actively participates, which we're given that information. That amount is reduced by the phase out. Remember, if you look up that part of the explanation in the book, you see that for any amounts over $100,000 for a married filing jointly individual, for each dollar above and beyond that, you're going to multiply that by 50%, and that will be a reduction of that max rental real estate loss of $25,000. So in this case, you had a $30,000 more than the $100,000 threshold. 50% of that is $15,000. So you take that $15,000 away from the $25,000, and you get your $10,000 deductible amount. So AGI is going to be salary income of $130,000 minus that $10,000 deductible amount, giving you an AGI of $120,000. So for Part B, we're supposed to look at the amount of suspended losses, if any, that may be carried over with respect to each activity. So we have total rental real estate loss here of $50,000, and then 10,000 of that is obviously going to offset activity X. So those would net out, and you'd have 40,000 left to play with. Of that 40,000, we're only actually able to use 10,000 in this situation as a deductible, which you see from Part A, which reduced you from a salary of 130 down to an AGI of 120. So now we're basically trying to determine, of that 30,000 real estate loss that we were not able to use in this situation, how much of that is attributable to activity Y, how much of that is attributable to activity Z. So you just look at the proportions that each of those activities made up of the total rental real estate loss. So activity Y was basically 60% or 30 of the 50,000, and Z was 40% or 20 of the 50,000. So you'll use that 60% for Y, 40% for Z, and multiply those percentages times the amount that was left over of 30,000, and you get Y with 18,000 of the suspended loss attributable to Y, 12,000 of the suspended loss attributable to Z. Okay, problem 851. In the current year, Ned completely destroys his personal automobile purchased 2 years earlier for $28,000 in a traffic accident. Fortunately, none of the occupants are injured. The fair market value of the car before the accident is $18,000. After the accident, it is completely worthless. Ned receives a $14,000 settlement from the insurance company. Later in the same year, his house is burglarized and several antiques are stolen. The antiques were purchased a number of years earlier for $8,000. Their value at the time of the theft is estimated to be $12,000. They are not insured. Ned's AGI for the current year is $60,000. What is the amount of Ned's deductible casualty loss in the current year, assuming the thefts are discovered in the same year? Okay, so let's do the math here. So you start with the automobile, and you're going to look at either the lesser of what the basis was or the reduction for fair market value decline. So basically, in this case, basis was $28,000. Fair market value before was $18,000. After was 0, so the decline there is $18,000. $18,000 is less than $28,000, so that's what you're going to plug in there. You're going to subtract out the reimbursement that he received from the insurance company, and we're left with a net loss before any limitations of $4,000. From that, we're going to subtract out the $100 floor, giving us a net loss of $3,900. Then we also have the theft of antiques, and in this case, we're just going to take, again, in this case, the basis was $8,000, and we're going to subtract out the $100 floor again, leaving us with a net loss in that case of $7,900. So we add those two net losses together and we get a total loss of $11,800. But there is also the 10% of AGI limitation on the total amount of casualty losses that we're able to take. 10% of our $60,000 AGI is $6,000, so we will subtract out 10% of AGI, and we're left with a $5,800 total deductible loss from casualty loss in the current year. $853. Elaine is a physician who uses the cash method, and this is going to be important in this question, uses the cash method of accounting for tax purposes. During the current year, Elaine bills Ralph $1,200 for office visits and outpatient surgery. Unfortunately, unknown to Elaine, Ralph moves away, leaving no payment and no forwarding address. What is the amount of Elaine's bad debt deduction with respect to Ralph's debt? Okay. So obviously this is going to be a business bad debt because we're talking about Elaine in the context of her business is billing for services performed. Now, since she is a cash method, and what we're looking at here is, does Elaine have a basis in this receivable? Since she's a cash method or someone who uses the cash method of accounting for tax purposes, unfortunately for her, she has no basis in the receivable because revenue is not recorded for a cash basis taxpayer until it's actually the cash is received. Had she been an accrual basis taxpayer, then that would be a different story, but in this situation, no basis equals no bad debt deduction. So she is left with $0 bad debt deduction for this current year. Okay, this is going to be, we just looked at a business bad debt issue. This is going to be a non-business bad debt issue. Problem 854. During 2013, Becky loans her brother Ken $5,000. Excuse me. Which he intends to use to establish a small business. Because Ken has no other assets and needs cash to establish the business, the agreement provides that Ken will repay the debt if and when sufficient funds are generated from the business. Becky and Ken do not establish any type of interest rate. The business ends up, surprise, surprise, being unsuccessful. Ken is forced to file for bankruptcy in 2014. By the end of 2014, it is estimated that the creditors will receive only 20% of the amount owed. In 2015, the bankruptcy proceedings are closed and the creditors receive 10% of the amount due on the debt. What is Becky's bad debt deduction for 2014 and then again for 2015? Well, some of that information in the tail end of the question there is a little bit of a red herring because what we first need to do for non-business bad debt is determine, since they are related, we need to determine if there was ever really a creditor-debtor relationship established. And in this case, apart from the fact that Ken is Becky's brother, the most relevant piece of information here is that they do not establish any type of interest rate. In that case, it's basically pretty much a foregone conclusion that this will be looked at as if no debtor-creditor relationship is established. If that is the case, then we don't really care what the bankruptcy ends up doing for creditors because Becky would be considered to not be a creditor and the amount that she loaned her brother Ken would just be looked at as a gift. So what does that mean? For 2014 and 15, since there was no debtor-creditor relationship established, the bad debt deduction is going to end up being $0. So pretty straightforward there. Okay, last but not least, this is probably the area that I think in the chapter is a little bit confusing, at least the way the book conveys it. So we'll take a look at it. It's net operating loss issues. Michelle and Mark are married and file a joint return. Michelle owns an unincorporated dental practice. Mark works part-time as a high school math teacher and spends the remainder of his time caring for their daughter. During the 2014 year, they report the following items. Mark's huge salary of $18,000, interest on a savings account of $1,200, interest paid on a personal residence, itemized deductions for state and local taxes, and then we have some separate items related to Michelle's dental practice, which she owns and is unincorporated. We've got revenues, and then basically a bunch of expenses. Question A, what is Michelle and Mark's taxable income or loss for the year? And B, what is Michelle and Mark's net operating loss for the year? So the fact that those are two separate questions suggests that taxable income and net operating loss are in fact different concepts. And if you remember from how the book shows you how to calculate net operating loss, they expect you to figure taxable income and start from there to start adding things back in to get to net operating loss. So let's start with taxable income for the year. So for taxable income, they will end up with a loss of $35,150, and that's based on the following calculations. If you net out all the items that are showing there in relation to Michelle's dental practice, that leaves you, so you take revenues, subtract out all the expenses, and you're left with a net balance of a loss of $30,100. You use that $30,100 to net against Mark's salary and the interest on the savings account, and when you net those two together, you're left with an AGI of $10,900. In this case, we're going to assume that these are all the possible itemized deductions. When you look at those and add them up, you have the $7,100 plus the $3,400. That ends up being less than what the standard deduction for Michelle and Mark would be for the year, and that's $12,400. So you use the standard deduction in this case. And then you have three personal exemptions for Mark, Michelle, and daughter of $11,850. So you take the 10,900, subtract 12,400, or the negative 10,900, subtract 12,400, subtract 11,850, and you're left with the total taxable income of a loss of $35,150. So what is net operating loss? So remember, net operating loss has some special characteristics, and basically what you're doing here is you're looking at essentially a business loss. Okay, and why that's important is because remember, you'll be looking at business income on Schedule C. You'll pull basically the net of business income and business loss over from Schedule C onto the 1040, and that becomes a 4 AGI or above the line AGI deduction. So you need to be able to keep separate track of net operating loss, because in whichever years that's carried forward or back to, that is going to end up being used as a 4 AGI deduction. So it's going to end up changing AGI for those years, which obviously has a big effect on a lot of things, because once AGI changes for the year, then you could end up having the various other deductions that use AGI as kind of a threshold limit, whether that's a floor or a ceiling. So if you end up carrying back a net operating loss, AGI changes in a previous tax year, you end up also having to change out anything that used AGI as a threshold limit within the deductions for that year. So a lot of changes can end up happening from this. So the basic idea is you're going to take your taxable income for the year, and you're going to get that back to the net operating loss that's attributed to the business income. And in this case, so the end answer is net operating loss of $12,100, but we start with the loss of $35,150. Add back in the excess of non-business deductions minus non-business income. So non-business deductions was just the standard deduction of $12,400. Non-business income was just the $1,200 from savings. So you are going to add back in 12,400 minus $1,200. So that ends up being 11,200 that you're adding back. Add back in the personal exemption of 11,850, and when you add those two back in, you're left with the total of 12,100 as a net operating loss. Okay, so I think the most complicated part of that is just understanding why net operating loss is calculated separately, and what it is showing you. And then I think once you have that down, it's a little bit easier to understand the purpose of it and how to calculate it.